This is not a passing ailment, but a condition that has been building for years, manifested in persistent, weak output per hour, declining business investment, and a widening gap with peers, even as households report rising financial strain and a diminished sense of progress.
Hello, everyone. Welcome to the Center for International Governance Innovation. My name is Paul Sampson, president of CIGI. This is the second chapter in our Canadian Standard of Living, Productivity and Innovation series for 2026, which will be continued with more to come. In the first lecture, we heard from Ricardo Hausmann, who gave a powerful outside perspective on Canada's economic challenges, and he pointed to some successes as well. Professor Hausmann reminded us to look at Canada's economic performance from several angles and not just through a few headline numbers. I thought it was interesting that he pointed out that averages can sometimes hide as much as they reveal. His example was memorable in my mind. If one billionaire walks into a packed stadium, the average wealth of everyone in that stadium suddenly jumps up massively, even though no one's actual situation has changed, right? So again, the numbers, right? So what matters here in the productivity discussion is equally a key question is not whether the economy is growing, but who is benefiting from that growth, right? So that was a major takeaway for me in part one of this series. Today, the lecture will continue to drill further into productivity challenges that Canada faces and also start tracking some of the solution paths forward. So before I introduce the speakers tonight, let me start by thanking the Savas Chamberlain Family Foundation for their support and partnership. And I know we have Dr. Savas Chamberlain here with us now. Thank you. Thank you for supporting this event. I want to also note our partnership for this lecture series with Canada's Financial Post and the Ottawa-based Centre for the Study of Living Standards. I would also like to thank and acknowledge the support of entrepreneur Jim Balsley, who founded CIGI 25 years ago. It's our 25th anniversary right now. So it's a real pleasure to introduce our speaker today, Anil Arora, someone who has dedicated his professional career to partnering with business, academia, and all orders of government. He has a very rich career. He was chief statistician for 8 years, during which he led the modernization of Statistics Canada into a digital governance and data-focused organization and built the infrastructure around that. He's had a distinguished career in government over many years, including as Assistant Deputy Minister both at Natural Resources Canada and Health Canada. And he's advised CEOs, Prime Ministers, Cabinet Ministers, and Premiers and Deputy Ministers and led missions abroad. He holds a Bachelor of Science degree from the University of Alberta, which is his home province, and he teaches a course on digital governance, AI, and leadership at Harvard's Kennedy School of Government. He serves in many different capacities, including on CIGI's board. It is also a great pleasure to introduce Denise Hearn, who will lead the discussion following the lecture, and we're in her hands on how she will do that, and she's got lots of very interesting ideas to bring to the conversation. Denise is the Director of Strategic Initiatives at the Long Now Foundation and an applied researcher working at the intersection of economic policy, technology, and long-term governance. Her advisory includes work with governments, financial institutions, companies, and not-for-profits, and is focused on economic policy, market regulation, and organizational strategy. And I also know her from her book that came out in 2024 on The Big Fix, How Companies Capture Markets and Harm Canadians, of which she is the co-author. So delighted that she is with us here this evening as well. I'm going to invite Anil Arora to join us now on stage, and over to you, Anil. Thank you again for this evening.
Thank you very much for that very generous and kind introduction. Good evening, everybody, and thank you for being here. Welcome. Yes, there will be slides, there will be graphs, there will be charts. I don't think we have too many formulas, so you should be okay. I do want to, first of all, recognize that we are meeting on the traditional territory of the neutral Anishinaabe and Haudenosaunee peoples on land that forms part of the Haldimand Tract. This acknowledgement is not only about history, but it's about recognizing ongoing relationships to the land systems of knowledge and governance that continue today. As we engage in discussion and learning, it is important to reflect on how our work can contribute to respect, inclusion, and a more complete understanding of the communities and histories connected to this place. So today's lecture is entitled Challenges and Opportunities for Canada's Standard of Living, part of the Canadian Standards of Living, Productivity, and Innovation lecture series, as Paul mentioned. I want to thank, first of all, the Savis Chamberlain Foundation. Savis, thank you very much. CIGI, of course, and Jim Balsillie, who is a good friend. The Center for this Study of Living Standards, and of course, our media partner, Financial Post. I do want to say that this presentation would not be possible without the dedication of Andrew Hugh Gibson. Andrew, please stand up. I do want to recognize Andrew and his immense contributions to this important work, and I know we'll continue that work long after this lecture as well. So our productivity problem in Canada increasingly, I would say, resembles a patient who arrives at the doctor's office and says, you know, I just haven't felt myself for a long time. The complaints aren't dramatic at first, but they are persistent and they are cumulative. Constant fatigue, difficulty keeping up with daily demands, mounting stress, restless nights, and the unsettling feeling that despite working harder, life is becoming more difficult rather than easier. Does that sound familiar in terms of the narrative that we have today in Canada? And what is most concerning about this to the physician that's looking at these symptoms is not the fact that it's just one single symptom, but it's a pattern, and the symptoms are lingering, becoming more widespread, and increasingly affecting day-to-day functioning. And recent Canadian polling and official statistics strongly validate this particular picture, this feeling. Statistics Canada's data reported that in 2024 that nearly half of Canadians said rising prices were greatly affecting their ability to meet day-to-day expenses. Up sharply from just 2 years back. Younger adults, households with children, and lower-income Canadians reported especially high levels of financial stress, housing anxiety, and expectations that they may need support from food banks or community organizations. And meanwhile, research from Angus Reid Institute consistently shows the cost of living, housing affordability, and financial pressure dominate Canadians' concerns, with many reporting that they see little relief ahead. Other national surveys have found Canadians delaying retirements, home purchasing, family formations, and other long-term goals just simply to get by on their current expenses. So from that physician's perspective, these are not isolated complaints. They are symptomatic of an underlying condition that has been developing for years. And the challenge for Canada is that productivity weakness rarely announces itself with a sudden collapse. It's like that little leak in the tire that just is annoying enough until you go to the garage one morning and you can't go to work. It manifests gradually through declining economic stamina, rising strain on households, and growing sense among citizens that despite their best efforts, they are slowly falling behind. So let's look at how our patient is presenting him or herself. Let's do some diagnostics. Let's develop a diagnosis Let's understand relevant comorbidities and point to intervention to improve this prognosis. So productivity, as you all know, is the efficiency with which an economy transforms inputs, labor, capital, energy, and knowledge into output. In practical terms, it is most commonly measured as output per hour worked. But conceptually, it captures something broader, the ability of society to generate more value from the same or even fewer resources. And over the long run, productivity is the primary driver of real income per capita. It underpins wage growth because workers can only be paid more substantially, more sustainably, when they produce more value. It expands consumption possibilities, allowing households to enjoy a higher standard of living. It enables improvements in health and quality of life by supporting better public services, innovation in healthcare, investments in our infrastructure. And it strengthens economic resilience by increasing the capacity of governments and firms to absorb shocks, invest in the future, and adapt to changing conditions. In this sense, productivity is not just an economic metric. It's not just a math problem. It is the measure of a society's ability to convert effort into enduring prosperity. So why is this relevant today? What distinguishes the present moment is that transformation today is unfolding across multiple dimensions simultaneously. And the pace itself is accelerating. If the technological shifts alone weren't profound enough, it is occurring alongside significant changes in global geopolitics, the evolution, and in some cases, fragmentation of global governance institutions, rising political uncertainty, demographic transitions marked by aging populations, and the reordering of global supply chains. Moreover, this is not a single technology revolution. It is the convergence of several powerful technologies: AI, quantum, blockchain, computing, advanced connectivity, and data ecosystems that together are reshaping how we work, how we interact, and how we generate value. Unlike the Industrial Revolution, which unfolded over generations, today's technologies diffuse rapidly across borders and sectors, compressing the time available for adjustment. And it's that difference between atoms and electrons, right? They move at the speed of light. This creates extraordinary opportunity, the potential to unlock new sources of productivity, enable more personalized and efficient services, and accelerate innovation across virtually every domain of our economy. And at the same time, it introduces significant risk. The labor market disruption, increased concentration of economic power, governance gaps, and erosion of trust if institutions fail to keep pace. So the first question is whether this patient's complaint is genuine. Is this a real problem requiring intervention? Some have argued that this is actually just a measurement problem. We're just not measuring things right. And others have said, well, this is related to COVID, right? And it'll work itself through, right? In Canada, we were just locked down for too long. And it'll just, it just needs more time. So let's quantify the productivity in this living standard gap. When we look at GDP per capita, as you see on this graph here, adjusted for inflation, we see a story of distinct eras with different trends. So you see from 1990 to 2000, our GDP per capita increasing rapidly. Look at the tangent on that. It's pretty steep, right? From 2000 to 2008, that slope, well, you see it kind of gradually change, right? And then from 2008 to roughly 2020, it flattens further. And from 2020 to 25, you saw this flattening. So you see that in each successive era, that has been marked by some form of a shock, we have resulted in having a lower growth rate than the one before. So this trend, which keeps flattening, is problematic because we are not recovering as we should, and we should be asking, why not? Well, before going further, we need to control for effort, right? If a neighbor makes less money, but they also work less, well, you go, okay, well, that kind of makes sense, right? But what this chart shows is the output generated per hour worked in Canada compared to that of our neighbor, the United States. Canada's figures have always been lower, so that gap has always been there. But have a look, that gap is widening. The trajectory of productivity growth in Canada over the last 2 decades reflects a gradual and persistent weakening that spans multiple economic cycles. In this period leading up to the global financial crisis, we experienced relatively stronger productivity performance, supported by favorable global conditions, higher commodity prices, and solid real GDP growth. However, even in this period, underlying productivity gains were more modest than in the United States, with the OECD data showing Canada already trailing in output per hour worked. And following the crisis, as global demand softened and investment patterns shifted, we entered a prolonged period of slower productivity growth. So between 2000 and 2019, labor productivity growth averaged just 1% annually, well below historic norms and weaker than our key peers, reflecting slower gains in real GDP relative to labor input and weaker contributions from multi-factor productivity and intangible capital. In the pre-pandemic decade, these trends became more entrenched. You see, labor productivity remained subdued, averaging around 0.8% annually between 2015 and 2023, again, significantly below the United States and the OECD average. And this period was characterized by modest real GDP growth, but relatively stronger growth in hours worked, which diluted gains in output per hour. So structural factors such as weaker business investment, slower diffusion of innovation, and lower accumulation of intangible assets continued to weigh on our productivity performance. While our economy demonstrates resilience in aggregate GDP terms, growth in output per capita and productivity remain weak, underscoring this disconnect between the overall economic expansion and our efficiency gains. And more recently, in the post-pandemic period, productivity trends have become even more volatile, and I would argue even more concerning. Statistics Canada's data show that quarterly productivity movements have been uneven, with declines in some quarters, followed by short-lived rebounds, driven largely by fluctuations in output relative to hours worked, rather than sustained efficiency improvements. So for example, in 2025, our real GDP in the business sector grew by about 1.9%, while hours worked grew more slowly at 0.8%, resulting in what you see is a modest increase in productivity, but one driven primarily by labor input dynamics rather than structural gains. At the same time, broader indicators such as our real GDP per capita have shown signs of stagnation or decline in recent periods, reflecting this combined effect of modest output growth and rapid population increase. The OECD 2025 analysis further underscores this productivity growth in Canada and has remained weak in the most recent years, around 0.5% annually from 2019 to 2023, and that's where the US really pulled ahead. Taken together, the evidence suggests that while the Canadian economy may exhibit periods of short-term recovery or resilience in headline GDP growth, these movements largely reflect cyclical adjustments in output and labor utilization rather than a fundamental strengthening of productivity. And so the question, returning to that medical analogy, is whether this gap is because they are getting healthier, i.e. the US, or because we are getting worse here in Canada. And against the OECD average, Canada looks acceptable today. We're performing roughly in line with peer economies. But the OECD long-term projections, so if we keep that, that trend that we have seen, it paints a particularly bleak picture for Canada's productivity growth. According to their analysis embedded in their economic outlooks and surveys, we are expected to experience the weakest labor productivity growth among advanced economies over the coming decades, with per capita growth projected at roughly 0.7 to 0.8% annually through all the way to 2060, placing us at near the bottom of the OECD countries. Now, the implication is that absent meaningful policy and structural reform, we risk falling further behind our peers in both productivity and living standards. So if this trajectory holds, the consequences would not be abrupt, but cumulative. Slower wage growth, tighter fiscal capacity, reduced investment, and diminished economic influence over time. And these projections serve less as a predictor of decline than as a clear signal of the urgency of addressing the structural drivers of productivity before this gap becomes more deeply entrenched. So this brings us to the household experience, disposable income per capita in the money left over after taxes and bills, right? The gap between us and the United States has widened dramatically since 1995. American household disposable income is now almost $30,000 US, larger than our Canadian equivalent, nearly double. While part of the Canada-US gap in household disposable income reflects the US's wider income distribution, Paul mentioned that in his opening, right, which lifts averages through much higher incomes at the top end, the difference cannot be explained away by inequality alone. So OECD data showed that the US has substantially higher income inequality than Canada. I think we know that, right? With a disposable income Gini effect coefficient of roughly 0.4 versus us of 0.32 in Canada. And research from the Bank of Canada suggests the top earners account for a significant share of the overall Canada-US income gap, particularly in average measures. However, even when comparing median disposable income, the income of the typical household, the US still maintains a meaningful advantage. OECD data placed the US median disposable household income at roughly 20% higher than Canada's on a purchasing power adjusted basis. So the persistence of this gap beyond the top end of the income distribution points to real underlying productivity differences between our two economies, reflecting stronger output per worker, higher business investment, and greater capital intensity in the US. And so this suggests that the problem we are investigating is not just academic, it is very real. So now that we have established the problem is real and it exists, let us do some further diagnosis. Rather than looking at the Canadian economy as a whole, let's examine it sector by sector. Here we have multi-factor productivity by sector. So MFP, which Statistics Canada uses interchangeably with total factor productivity as used in the OECD and some of the academic literature. It's the ratio of the outputs to inputs. So in broad terms, if we invest $100 of labor and capital, and we, let's say, get back $105 of revenue, well, the MFP is 5%. Something should stand out immediately. Mining and oil and gas had an extraordinary MFP run from roughly 1990 through 2008 to 2015. In fact, we saw some of those gains even in the 60s and even earlier. The hypothesis that's forming here is whether Canada is broadly getting worse or whether we simply had one sector that was incredibly productive, which has since declined substantially. And so this chart represents the same data, and now it's indexed to 2000. Compared to the level of productivity that oil and gas achieved in 2000, it's decreased substantially to roughly 60% of its former level. And so from the perspective of the Canadian household, here is one sector that now operates at 60% of its former profitability. That is no surprise that will have an outsized impact. When we separate goods producing from service-producing sectors, services, the largest portion of our economy, shows a reasonably good upward trend. So this unwellness, per se, does not appear to be coming from services. What is emerging is that the euphoria of the 1990s through 2008 and 2010, driven heavily by oil and gas, gave way to a collapse in that income, and that is what is causing us to feel what we feel today. Let's understand this more rigorously. I want to draw attention on some research from McMaster University that analyzed how oil and gas fits into the Canadian economy at the aggregate level. So the researchers there compared Canada and the US with aggregate multi-factor productivity and MFP excluding oil and gas, shown separately here. For the US, removing oil and gas changes almost nothing. Oil and gas is a relatively smaller share of their massive economy, typically around 1% to 2% for extraction, roughly 3% to 4% when you include their broader energy activities. For us here in Canada, however, removing oil and gas changes everything. It accounts for a much larger share here, at approximately 5% to 7% of GDP for just extraction and closer to 8% to 10%, including related industries. So this suggests that in Canada, non-oil productive capacity relative to the US has been broadly stable. The problem is concentrated in oil and gas. And so the chart shows two things about oil and gas and its footprint. First, oil and gas as a share of Canadian economic output reached as high as 20% versus 2% to 3% for the US. And second, the share of all Canadian capital invested in oil and gas production approached 33% by the mid-2010s. A third of all capital in the country directed towards one single sector. One marker worth noting, around 2001 is when we significantly scaled up oil sands extraction and extraordinarily an extraordinary capital-intensive process. To be clear, this is not an indictment of oil and gas, far from it. It was highly productive. We invested that capital because it was rational, it made sense to do so. And on the margin, it continues to be profitable. The problem is what happened to the rest of the economy in the meantime. The structural difference matters for productivity. In Canada, the larger weight of a highly capital-intensive but volatile sector means that swings in global energy prices and shifts between investment and production phases can materially influence aggregate productivity, often boosting it during periods of strong output and strong prices, but weighing on it during downturns or when large capital projects are underway without that immediate return in the output gains. In contrast, because the sector is a smaller share of a far more diversified economy in the US, its impact on overall productivity is nuanced. It's muted and stable over time. So it allows for broader gains in technology, services, and manufacturing to play a larger role in driving sustained productivity growth. So let's talk a little bit about that capital misallocation and where Canadian capital lives. Looking at where capital actually flows in the Canadian economy, engineering, construction, essentially oil and gas, productive infrastructure, and residential capital have absorbed the largest share. Intellectual property and machinery and equipment dead last, shrinking relative to 2008 and have been left behind. Looking at capital growth rates, engineering capital is the highest gainer, right? Second is residential capital, which in StatsCan terms, they don't include it in MFP calculations because the house you live in does not meaningfully contribute to productivity output or productive output. It is important for households and the quality of life, of course, but we can't become the wealthiest country in the world by producing houses for ourselves, right? Non-business capital, government spending, healthcare, education, infrastructure have also grown strongly and non-linearly with population. That additional spending, of course, has to come from somewhere, right? So who is losing? business non-residential capital. Everything in the productive economy that is not oil and gas extraction or a building. And machinery and equipment, the bedrock of industrial capacity, both have been shrinking. So this is sounding a lot like the Dutch disease. And some of you may have heard about this concept of Dutch disease, which was coined by the economists in 1977 to describe the economic challenges faced by the Netherlands after large natural gas discoveries led to currency appreciation and a declining in their manufacturing competitiveness. The underlying mechanism was later formalized by economists Corden and Neary, who showed how a resource boom can shift labor and capital towards the booming sector while increasing national income and demand. And this in turn raises the real exchange rate, making other tradable sectors less competitive and potentially weakening broader economic diversification and longer-term productivity growth. The Dutch disease, in a sense, has two classic crowding mechanisms. The first is the spending effect. A natural resource sector raises wages and costs across the economy, making other exports uncompetitive. So for example, if you're a manufacturer in Alberta, you must compete for labor with oil and gas companies, which of course substantially raises the reservation wage economy-wide. The second is resource movement. Capital and labor migrate towards the profitable resource sector. And of course, that then leaves less for everything else. Canada's oil and gas boom from roughly the 1960s through to 2014, it exhibits textbook versions of both these mechanisms. And there's an additional channel, housing inelasticity in productive cities, which further captures the gains from these exogenous productivity shocks. And that compounds the crowding effect, a mechanism that's been documented by economists. So to visualize this and what this means for the economic complexity, I want to introduce the product space, a framework that was developed by, in fact, our previous speaker, Ricardo Hausmann, at Harvard Kennedy School, and Cesar Hidalgo. The product space maps an economy not just by what it produces, but by how the know-how involved in each product relates to know-how in adjacent products. So if you can make a car, for example, you can likely retool it to make a tank, right? Skills, technology, supply chains that are adjacent. This adjacency determines how easily an economy can pivot through shocks. And in 1995, Canada's product space showed a scattered but reasonably diverse productive capacity with substantial clusters in areas such as metalworking and machinery, areas with high density of adjacent activities. Capability is one of those products, in one of those products means many others are accessible without major, substantial new investments. Well, by 2024, right, the losses are significant. Electronics, right, a dense, high adjacency cluster, contracted. Metalworking and machinery, again, high adjacency, contracted. Gains are concentrated almost exclusively in agricultural goods. And oil and gas has become a larger presence in an increasingly isolated corner of this product space. The isolation is critical. Oil and gas has fewer adjacent economic activities. If the entire productive base concentrates in oil and gas and something disrupts that sector, well, there's little to go, little where else to go, almost nowhere to transfer. And the contrast to the US is important here when you look at the product space, and it's stark. The US economy is broadly and densely distributed across metalworking, machinery, electronics, chemicals, and base metals. If any part of that economy faces a negative shock, well, there are large adjacent nodes ready to absorb the disruption. If there is a positive shock anywhere, there is an entire surrounding ecosystem that is ready to capture it. The Nortel case is instructive. Canada once had significant productive capacity in electronics, and following Nortel's bankruptcy in January 2009, its patent portfolio approximately $4.5 billion US, was auctioned in 2011. And most of those patents, right, were purchased by non-Canadian firms. The result of this shift is that Canada's exports have become less diverse in that top graph, as you can see, and significantly less complex, right? And that's what you can see in the bottom graph. And so the classic Dutch disease model has this self-correcting mechanism. The resource boom raises the currency, right? Manufacturing gets crowded out. Let's say the boom ends, the currency starts to fall. Well, guess what? Your manufacturing starts to recover. That's the script, right? Canada's reality, of course, diverged from this classic mechanism. And there are 5 structural reasons the recovery mechanism has failed in Canada. The first 2 are capital side breaks. First, stranded oil and gas capital. Right? Approximately $400 billion was invested in oil and gas, oil sands and extraction infrastructure, assets that are sector-specific and cannot be redeployed to manufacturing. And so what I was talking about earlier, or services. And the second is sticky deindustrialization. So this manufacturing's GDP share fell from 16 to 10% during the boom, and it just simply did not recover. Supply chain skills and supplier networks were dismantled. The third pillar is housing as a co-channel. Residential construction absorbed 25 to 30% of annual capital investment, crowding out productive business investment while adding nothing to our multi-factor productivity. The final 2 are mechanisms side breaks. Fourth, Canada had no federal stabilization fund. Norway's government pension fund and Alberta's heritage fund show resource windfalls can be saved to buffer downturns. We, of course, had no federal equivalent. Let me tell you a little bit about Norway's government pension fund global. It is now valued at roughly $2.1 trillion US dollars, 1.5 times the country's GDP, equivalent to roughly $400,000 US per citizen. And it was deliberately designed to insulate the domestic economy from classic effects of resource booms. By channeling oil and gas revenues into a globally diversified portfolio holding about 1.5% of all publicly listed equities worldwide, rather than spending them directly at home in Norway. Norway limits currency appreciations, it dampens domestic pressures, and avoids crowding out other tradable sectors. The core mechanism of the Dutch disease, right? And at the same time, its fiscal rule allows only a modest, stable share of the fund's returns to flow into the domestic economy each year, smoothing revenues across commodity cycles. And this results in this shock absorber effect that reduces volatility, it preserves competitiveness, and supports more stable long-term productivity growth. In Canada, what did we do? We consumed it. Right? Fifth, important inelasticity. Household consumption of food, consumer goods, and vehicles were price inelastic. Demand did not fall as the Canadian dollar weakened, forcing real income compression rather than domestic adjustment. So this brings us to the next question, this currency asymmetry. The classic expectation is that when the boom ends and the currency depreciates, the crowded out sector should recover, right? And the weaker currency becoming a competitive tailwind. So let's explore whether this happened, right? From 2008 to 2015, the Canadian dollar maintained near parity with the US dollar. Following the oil price collapse in 2015, you see the Canadian dollar depreciated sharply and remained depressed. A 25% depreciation should, by textbook theory, stimulate our exports, right? They're a lot cheaper. Well, the export response was real, but it was very selective. Some sectors did respond, but we need to be precise when dealing with currency fluctuations. We can't just look at nominal export values. The 25% fall in the dollar makes everything appear 25% more volatile, more valuable in Canadian terms, even if nothing actually changes. right? So let's look at volumes, right? You have to look at volumes. And so looking at merchandise trade export volumes by sector, we do see some upward trends in several areas post-2014. On this correlation chart, the Pearson R measures how elastically each sector responded to this weakening dollar. Consumer goods and farm, fishing and food showed the strongest response. Machinery, forestry, and aircraft showed meaningful but smaller responses. There's a critical caveat here. Every sector that responded strongly is a commodity or near commodity category with very low multi-factor productivity and very low margins. So we did increase our export volumes, but these sectors are just, not large enough or productive enough to really offset the losses that we saw from oil and gas. So the answer is no. Goods were already only about 30% of our economy, and these responding sectors are just a small fraction. They just cannot compensate. Meanwhile, the sectors with near zero responses, I was saying, are chemicals, electronics, and motor vehicles, are high multi-factor productivity, high quality employment industries, a 25% dollar depreciation, and business continued as usual in these sectors. That is this asymmetry. The industrialization stripped out the capacity that we would have needed to respond. The service picture is even clearer. We do see some increase in the commercial services, trade balance, accounting, IT, professional services, but this is denominated in Canadian dollars. So if that increase is less than 25%, the real value actually contracts in the services. The one category that responded quickly was travel. Canadians almost immediately cut foreign travel because it was unaffordable at the weaker rate. And so this is not export growth, that is demand rationing. And so households absorbed the cost of a weaker dollar by foregoing vacations, right? So when we analyze our expenditures on IP and R&D related activities, we can see little to no elasticity or correlation between currency and these trade balances. So we fail to capture the advantages of having a cheaper currency while being forced to pay higher prices for valuable inputs like IP products. And so this is not export growth, that is demand rationing. And so households absorbed the cost of a weaker dollar by foregoing vacations, right? Now, the household size aside, Canadian households import heavily, right? Food we can't grow domestically, consumer goods, vehicles, electronics. So look at import volumes. There is almost no change. Despite a 25% currency depreciation, our imports continued on the same upward trend. So households had no domestic substitute. We didn't have anything that we could buy here, so we paid the premium and bought them from somewhere else. So when the Canadian dollar was at parity and you wanted a consumer electronic, you bought an imported one. And guess what? When the dollar was 25% weaker, you had no choice. You bought the same imported good and absorbed the cost increase. Households are now paying 30 to 40% more for the same growing basket of goods compared to a decade ago. That explains why we don't have the income. We just don't have the disposable income. We're using it. One additional channel worth noting, the weaker Canadian dollar makes capital investment in productivity more expensive as well, right? If you want to start a firm that requires intellectual property, it requires machinery, it requires equipment that we don't produce domestically, guess what? You are now having to purchase it internationally and at that premium, that 25 to 30% premium. The currency weakness actively inhibits the investment in complexity and diversity in our economy, which is the exact thing that we are requiring. So we observe this on this slide, that our IP and our R&D related services appear relatively inelastic to the currency effect. So we fail to capture the benefits of a lower currency and suffer the downsides. The relationship between the Canadian and US dollar rate and manufacturing share of GDP diverges cleanly around 2005. As the Canadian dollar appreciated through the oil boom, manufacturing share fell. When oil prices collapsed around 2014 and the dollar depreciated, manufacturing share should have recovered. If this was merely a compositional effect of oil's relative size growing and then shrinking, well, it didn't. Between 2005 and 2014, manufacturing's role in the Canadian economy declined sharply. Manufacturing fell from roughly 16 to 17% of our GDP in the early 2000s to just 10 to 11% by 2014. The steepest drop occurred between 2005 and 2009, when these combined effects of a strong dollar, Canadian dollar, driven in part by the resource boom, intensifying global competition, and the global financial crisis that led to significant plant closures, job losses, particularly in Ontario and Quebec. So while the sector stabilized somewhat after 2010, it did not regain its previous share, leaving us with a structurally smaller manufacturing base and reinforcing concerns about competitiveness and the longer-term effects of this Dutch disease dynamic. So this brings us to the second set of structural constraints, the traps that prevent us from building the complexity we need, even when we try. Canada consistently ranks in the top tier of OECD nations for university R&D. Our post-secondary institutions are actually excellent. The problem is that there is no adequate domestic capacity to capture it. Canada has a comparatively higher share of R&D performance in the higher education sector, often exceeding 1/3 of our total activity, roughly double the OECD norm. Public sector, university-led research, strong, relatively well-funded, but it's inherently less oriented towards commercialization and market application than business-led R&D. And so as a result, Canada's innovation system is highly skewed towards knowledge generation rather than value capture. The absorptive capacity, the literature that shows establishes that firms can only absorb knowledge for which they have the internal R&D capacity to recognize. So if you don't have that receptive capacity, how do you absorb it? You can create and generate all you like, but you have to have that capacity. And the ability to capture spillovers is endogenous to firm size. So you have to be large enough to have an R&D unit and then be able to actually capture it and use it. You're not only contributing to the knowledge stock of a particular sector, you're also better positioned to commercialize gains from the R&D of others that are nearby in that ecosystem. And the second channel is direct R&D spillovers. Work by Bloom, Shankerman, and Van Reenen, published in the Econometrica in 2013, finds that large firms cluster in the technology space. And the ability to capture spillovers is endogenous to firm size. Firms that produce R&D are better at capturing R&D from others, creating this multiplier effect that I'm talking about. You're not only contributing to the knowledge stock of a particular sector, you are also better positioned to commercialize gains from the R&D of others that are nearby, as I mentioned. The second channel is direct R&D spillover, and again, finds that these large firms clusters in technology spaces with high spillover potential, and that the social return to R&D from large firms are more than twice the private returns. So the benefit to society of a large firm capturing R&D spillover in a sector exceeds twice the benefit of that firm itself. That's quite revealing, I find. Small firms have substantially less capacity to benefit from spillovers, operating in niche areas with limited adjacency to other innovative activity. And so Canada, unfortunately, loses on both counts. Fewer R&D firms in proximity to each other, and this lower absorptive capacity that we just don't see. And so, of course, the problem compounds. So looking at the relationship between IP capital investment and multi-factor productivity growth by sector. So the sectors investing most in intellectual property are not seeing proportionate productivity gains. And the sectors where we do see a positive relationship, professional, scientific, services, information, culture, finance, are exactly those sensitive to the housing dynamics in major cities. So our business activity is highly concentrated in a handful of large urban centers, namely Toronto, Vancouver, Montreal. they account for a disproportionate large share of GDP growth, high-skilled employment, and firm formation. These three metropolitan areas alone generate roughly 1/3 of our GDP, and an even larger share of employment in knowledge-intensive services such as finance, technology, and professional services. And at the same time, housing and commercial costs have escalated sharply. I think you all know that. You see average rents in Toronto and Vancouver increased by 40 to 60% just in the last decade, right? Home prices have more than doubled in some segments. And this concrete illustration is the technology sector in Toronto, where strong job and wage growth has been accompanied by rapidly rising office and residential rents. So much so that a significant portion of nominal income gains is effectively offset by higher housing and rental costs. The result is that much of that surplus that you generate, right, through those productivity services is quickly absorbed by land and by housing costs rather than translating it into sustained gains in real wages or reinvestment. And in fact, this agglomeration benefits are partially offset by urban cost pressures, with productivity gains being capitalized into rents, limiting their broader economic impact. So this spillover dose response chart makes this distributional problem visible, and Canada has disproportionately fewer large firms and disproportionately many small firms compared to the United States. The absorption coefficient rises with firm size, and our employment is thin precisely where this absorption is highest. So the R&D trap is most consequential in tradable sectors, a part of the economy that compete internationally, and that would drive our export complexity. This is where the absence of large R&D capable firms is most costly. So beyond our inability to recover from negative shocks, which I've talked about, we also must examine some of these comorbidities that compound and exacerbate everything that we've described. The first comorbidity is our demographic pressure, right? Canada, I know we say we're aging, I would say we're aged. As this cohort reaches retirement, the draw on public services increases while the tax base contracts. And to maintain this same quality of life, we have a limited set of options, right? We either have fewer people, worse services, higher taxes, or higher productivity. Higher productivity, I think, is the most appealing option. What makes this particularly troubling is the signal problem. The oil and gas sector that we talked about, it obscured those trends for decades, right? It is only around 2015 and going forward that the problem has started to really surface. And this is a compounding problem. First year, invisible. 10th year, start to ignore, like that leak that I was talking about in your car. And the 20th year, guess what? You can't drive out of the garage. The second comorbidity is Canada's high immigration rate combined with deindustrialization. New arrivals are disproportionately absorbed into construction, into retail and services, not into those complex manufacturing to the extent that they need to, right? These sectors are concentrated in major metropolitan areas that already suffer from housing unaffordability, right? More people flowing into cities without commensurate expansion of housing supply, this feeds into that rent extraction mechanism and compresses affordability even further. Now, we've talked about the problems. Now, sort of like where do we go forward? We have an emerging defense industrial policy which presents a clear opportunity to embed productivity growth at its core by aligning procurement, innovation, and data-driven performance management. By leveraging institutions and partnerships, we can shift from traditional cost-based procurement towards outcome-based models. These should reward efficiency, modular design, and life cycle cost reductions. This includes investment in advanced manufacturing, automation, additive manufacturing, digital engineering, and interoperable data systems. while ensuring that the small and medium-sized enterprises are integrated into stable and into scalable supply chains. A stronger emphasis on standardization, on open architectures, dual-use technologies. These can help accelerate innovation spillovers into the civilian economy. At the same time, coordinated investments in skills development, applied research, and domestic production capacity aligned with allies can reduce fragmentation and improve scale. If designed well, a defense industrial strategy can act not only as a tool of national security, but I think as a catalyst for sustained productivity gains, strengthening our industrial base and long-term economic competitiveness. We have comparative advantages in defense that are often underestimated, right? Geographic security, our production capacity is insulated from physical disruptions of conflict. This is a genuine strategic asset, as it was in the two world wars. That advantage is one we can capitalize on. We need to ensure that defense procurement is designed as an investment in domestic complexity and diversity. The choice of platform and the terms of sustainment matter. Programs that commit to Canadian production and maintenance keep the know-how here, and that translate directly into nodes on the product space. Now, the natural objection is that we do not want to be a branch plant economy, right? I totally agree. But there's a spectrum. Producing fighter jets, submarines, advanced defense systems, and partnering with international firms is not the same as assembling commodity goods. And the only credible path towards Canadian firms capable of leading in these areas in the future is to build the domestic know-how. Now, I mean, there's so many examples, right? I mean, you look at what's happened in Israel, look at what happened with Bombardier here. So we do have some experience to build on. Now, more broadly, we should actively pursue reindustrialization via foreign direct investment, deliberately rebuilding what we have lost in our complexity, our economic complexity, right? This approach has actually additional benefits. FDI inflows strengthen our Canadian dollar. They directly reduce the asymmetric household cost squeeze that we've talked about, and we cannot address the currency problem through monetary policy. Canadian households are just too exposed to the market debt for interest rate increases to be a viable tool. So the only sustainable path to a stronger dollar is through real investment flows. On the sovereign wealth fund, Norway's government pension fund global is the instructive model, as I talked about earlier. It is prohibited from purchasing Norwegian assets. The rationale, diversification, right? If the Norwegian economy faces an idiosyncratic problem, the fund is unaffected, right? In boom cycles, routing oil revenues into foreign investments puts the Norwegian kroner into international markets, offsets that upward currency pressure, keeping the broader economy competitive, and prevents that crowding out mechanism from reasserting itself. In downturns, less capital is deployed, so the currency pressure naturally eases, and the fund stabilizes the cycle structurally, not just financially. So the question of whether a Canadian sovereign wealth fund, right, there's talk about that, should invest domestically or internationally is context dependent, right? There is a reasonable case for targeting domestic reindustrialization investment right now, with the currency depressed and a genuine structural need to rebuild complexity. But the Norwegian principles should inform the design. In upward oil cycles, there should be a commensurate shift towards foreign deployment to provide the offsetting currency pressure and prevent the cycle from repeating. It must serve as a ballast to a strong but volatile oil and gas and mining sector critical to our economy. So in conclusion, the real problem is not that we have a resource sector. We have a valuable resource sector, and we are fortunate to possess it. The problem is what happens to it and to us in cycles. When oil and gas is in an upcycle, it absorbs our attention, our capital, and our labor. It makes other parts of our economy less productive and less competitive. And that would be acceptable if the oil and gas sector was permanently and it was reliably and sustainably profitable. But it isn't. The price of oil is cyclical, right? The future of energy technology is uncertain. We cannot afford to double down indefinitely. We need careful, deliberate management to mitigate the incentives that oil and gas generates, the incentives that cause us to emerge weaker after every downturn, after every shock, less resilient, less complex, and less capable of capturing the next opportunity. So the question is not whether to invest. The question is whether this time the investment makes our productivity and our productive structure more complex and more resilient than the one we had going in. If we return to the patient, the diagnosis is now clearer. This is not a passing ailment, but a condition that has been building for years, manifested in persistent, weak output per hour, declining business investment, and a widening gap with peers, even as households report rising financial strain and a diminished sense of progress. The evidence is consistent across industries and across indicators. Productivity growth has lagged, capital intensity has softened, and too much of our economic upside, whether from resources or high-performing urban sectors, has been absorbed by volatility or cost pressures rather than translating into broad-based gains. The prescription, therefore, cannot be incremental. It requires deliberate shifts, strengthening investment and competition, building shock-absorbing capacity through better fiscal and resource management, modernizing our data and digital infrastructure, and ensuring that the gains from innovation are not eroded before they reach households. As we move decisively into a data and knowledge-driven economy of intangibles, the urgency intensifies because the cost of inaction compounds quietly but relentlessly. At its core, this is about restoring affordability, improving living standards, and leaving the next generation with a stronger foundation than the one we inherited. Canada has the assets, the talent, the institutions, resources, and the global credibility. What is now required is a resolve and strategic foresight to place productivity at the center of our policy choices, not as a residual outcome, but as a deliberate objective supported by a culture that rewards investment, innovation, and execution. We need careful management to mitigate the incentives that cause us to emerge weaker from every downturn, less resilient, less complex, and less capable of capturing the new opportunity. Thank you very much.
Hello, everyone. Nice to see you. Thank you so much, Anil. That was phenomenal. I felt right at home. My first job after my MBA in London was working for a macroeconomic research firm, so I felt right at home with all of those charts. It was fantastic. So one of the themes that came through strongly for me in your presentation was this notion of more concentration and less complexity in our economy, actually at multiple levels. So you talked about it economy-wide, you talked about how we are over-concentrated in certain commodity goods, we're over-concentrated sectorally, we're also over-concentrated geographically, where most of the gains, flow to 3 cities. I wonder if you can maybe re-articulate that for us or talk about, diversity in our economy is similar to what we see in the biosphere, right? That the more biodiverse a region, the more structurally resilient it is. Why is it important to have that diversity at all of those kind of fractal levels of our economy?
Yeah, I think the first thing is that we were at one point more diverse. We actually had some of those, as some of the place-based chart showed. We actually had some, at least in some cases, some nuclei, right? Maybe not fully exploited. And the capital that got reallocated into the oil and gas sector, and then subsequent to that, the housing sector, actually just made those atrophy. So they just never got the chance to kind of get the oxygen, the kind of investment that was needed, and the growth, and the building the clusters. And so we need to go back to that. We need to go back to that. No, we have to do it. No, today is not 1960. Today is not. We have to look at the data and digital space, the intangible space, and we need to rebuild. I mean, we looked at the industrial, the defense industrial strategy that we're talking about. So let's build that complexity and that diversity, not at the expense of the oil and gas sector, but in addition to the oil and gas sector, because those returns are still very real. That endowment is very profitable. It's still very important for us. So we don't want to just grow big and poor. We want to grow big and rich as a country. And that is tied to our ability to complexify and to understand that it's going to take that system of ballast, as I talked about, that balancing, where as we see cyclical downturns in one, that we actually give the ability for that capital, we give that innovation, we give that spillover effect, the ability to actually still keep our standard of living and our productivity moving. So it's a both. It's an and proposition, not an or proposition. Mm-hmm. And you're right. We through more neglect, and I'm saying I think we need more direct strategy to start to, like, we're not lacking geography in this country, right? We can be, more than just the three big cities, as I mentioned in my lecture. Like, why do we have so much capital in those three cities, and I would even argue the next tier of cities, locked in, and then essentially feeding non-productive sectors? I think we can diversify other parts of our country that are just screaming for that kind of injection, and I think that'll be good for those areas, but it also builds the resilience that we need going forward.
Yeah, absolutely. Okay, so I'm a competition policy nerd. I've written 2 books about the effects of market concentration on the economy. And you hinted here or there about competition policy playing a role in expanding or increasing productivity. And I told you the anecdote actually before when we were chatting that in my most recent book that I co-authored with Vas Bednar, who's also associated with CIGI, I wanted to write a competition and productivity chapter. And I asked, I started asking a few folks for input, and they said, I don't know, it's too tricky. I don't think you should do it. I had a whole chapter drafted, so I scrapped it. About 6 months later, everyone was talking about competition and productivity, and they said, the people I had asked, they were like, oh, did you ever consider writing a chapter on competition and productivity? I did, in fact. So one of the things I want to tease out a little bit is you talk about ways that we can increase our productivity, but you're also pointing to the fact that households and workers are not gaining from even our modest productivity gains the way that they used to in the past. So the bargaining power of consumers, the bargaining power of workers has decreased over time. And one of the things that in my research, I think is possibly one culprit is the rise of monopolies and oligopolies, which themselves can then take more of those productivity gains by way of corporate profits and give less to workers and to consumers, or charge higher prices to consumers. And so I'm wondering if you can tease out a little bit how you see the connection between higher competition in our economy and higher productivity.
Well, so let me parse out, first of all, what are the inhibitors for capital investment? And I think there's no question that the regulatory burden has increased over time. I think trade uncertainty, which has led to just general uncertainty in terms of where's capital going to get its return. I think that uncertainty has not helped. And I think what do companies do when that happens? What does business do? They'll buy back their own shares. They'll start to increase their profitability. They'll start to, the bottom lines, they acquire, they merge, right? And so you see. I'm not blaming just the regulatory and the uncertainty, but if you look at all the trends, that's exactly where business has gone. Mm-hmm. And so, I think policy has a role to play in building incentives for businesses to invest and grow, and especially here in Canada. So we have to remove some of those obstacles that we just talked about. And absolutely, competition is real competition, not same investors that kind of in the background are investing in the same firms and they're just moving money around, but real competition where we actually grow the number of companies. And that too is a statistic that we've seen in this country being very problematic. We've seen the new entrants kind of either concentrated in some areas or actually in overall terms go down. And so that innovative spirit, that ability to create those ecosystems where we do see people taking risks, the startups that that want to grow businesses, not just get to a certain point and sell them, but we want them to actually as I said, nourish those ecosystems, complexify our economy in those clusters that we talked about outside of the 3 main cities. I think those are things that we can look at how it is that we reorient our policy outlook to incentivize some of those things. How do we de-risk in some cases, and how do we actually create? Now, we don't want to be overly prescriptive there, because I mean, if we're through policy design keeping firms that shouldn't exist, that's not very helpful. So we don't want to interfere with the market in a sense of keeping low performers there. But on the other hand, incenting that real competition and growth, I think is something that we need to pay a lot more attention to in this country. And the last point I'll make here is that competition in the large firms. I mean, look at Canada used to have in the top in the world, there 20 top sort of companies, 20, 30 companies 20, 30 years ago, and today we have a handful, if that. And so we don't want to become branch plants and just have competition between branch plants, and especially not in the knowledge economy. You're just we're just kind of like that's just IP just leaving, and we're just paying rents. So we have to be smart about how do we rebuild that competitive spirit, and mindful of the fact that in the intangible space it's a very different space, and so we do need to figure out how do we capture and retain. And how do we actually commercialize a lot of that wealth that we created right here? And so growing smart with the kind of policies in play. So yes, competition, but in a healthy way that recognizes the fact that the world is very different today.
Mm-hmm. Okay, I want to push on this just a little bit more, if that's okay. So one of the main trends that we've seen across most OECD countries is over the last 20, 30, 40 years, waves of mergers and acquisitions, right? And it's not just in technology or finance, it's really across almost every industry. And there's a great economist in the US who actually analyzed thousands of mergers in the US. And what happens when merging parties go to the antitrust regulators or to the competition regulators, right? They say, we're going to create all of these new synergies, and we're going to pass those costs on to those cost savings onto customers, right? We're going to lower prices, and it's going to be fantastic, and everyone's going to be happy. Well, the research shows that in 95% of cases, when you have a merger that leads to 6 or fewer competitors within one industry, do you think prices go up or down following the merger? Anybody?
Loaded question.
They go up, yeah, yes. Of course. They go up because now they have market power and they can use that pricing power against consumers, right? So one thing I want to tease out with you, because in your presentation you talk about large firms being important to our economy in the sense that they have the capacity for R&D, they have the capacity to absorb R&D and intellectual property coming out of the universities, and I completely agree. But I want to talk about, in Canada, we also have these old firms, very, very old, much older than US firms, that have been around for a while. They're maybe not that incentivized to invest in new R&D or invest in CapEx projects because they're kind of cozy and they've got a good deal going on. So talk about, large firms. How do we actually manage them in a way that increases this kind of productive capacity that you're describing, especially in Canada where we have, large firms across many of our industries?
Yeah, I mean, it's what is that, $64 million question, or billion, I suppose. Look, you can't, I think First of all, you're absolutely right, especially in the digital space. I mean, just have a look at the kind of massive amounts of investments that are needed. And in the digital space, you look at the scrapping rate, the depreciation of assets is a lot, that time is much shorter than in machinery and capital costs and so on. So first of all, a recognition, okay, that structurally is a very different play. And you have to recognize that the amounts of capital that are needed to keep those solvent and reinvesting and so on, I think are very real. And that in itself builds competition. And, so if you want a sector to flourish, you have to allow for, that kind of massive investment without kind of, crippling it and, knocking it at the knees kind of thing. But, that's not to say that, should be just letting, at some point, this kind of apparent competition, which then turns into, oligopoly, which then turns into lobbying, which then, as you rightfully, pointed out, becomes a negative for the consumer. And yes, we see market failures, and we see those kinds of things. So we can't be naive about that. That does happen, and we need to be mindful of that. But you know what? I'm optimistic that I think the current shocks that we're facing, you see this movement to say, look, Canada's strong, Canada first, Canada. I think big companies do respond. I mean, speak to the Business Council, speak to some of the big players. They understand this is an important moment for Canada, and they need to complexify, right? They need to diversify. They're going to have to, they can't be themselves just caught in one area, just given the uncertainty, and who knows tomorrow whether they're going to be around. Just because you've been around for a couple hundred years doesn't guarantee you're going to be around next year. So I think they're attuned to that fact. They're aware that they're going to have to start to now move things. The question is, how is a regulatory environment? How does competition policy? How do some of the incentives that we've got in place allow for that kind of diversification, complexification in the areas that we think are high productivity gains, and they now actually align with Canada's reality, sovereignty, and we have diversity. The Canadian values play into these things. Politics is very real. Politicians have to worry about bilingualism in Quebec and Alberta. Notice they have to worry about a number of these kinds of things. So we're not just kind of going to a more complex matrix where there are a number of dimensions that now have to be factored into, but I think we can. We can deal with complexity, and I think we need to build the kind of the incentives and the policy structure. Even if you look at one of the things that we were talking about earlier, you look at our tax treatment and the size of firms. It's interesting how those are correlated, and so we have to rethink those and say, well, like, are those inhibitors for companies to grow? Are we why is it that when we give special treatment to firms that are at a particular size, why is it that they cap out at that size? So we need to, I think it's a great opportunity to go back and look at some of those policies and some of the treatment that we've got, but with the new lens. And as I keep saying, put productivity at the center, because that's really, really important.
I appreciated also in your presentation, I felt like there was maybe some subtle nods that were a little bit of like a knock on neoliberal ideology. For instance, in your concluding slide, you said, for consideration, maybe we should move beyond a sort of free trade alone perspective, and that we should actually consider strategic industrial policy. And I would say Canada has been much better than the US in this regard, but do you feel that there's now an opening in terms of our own paradigms, in terms of our own ways of thinking about economic policy, where, because for many years it was the famous Reagan quote, like the scariest, words in the English language are, I'm from the government, I'm here to help, right? And so we had this notion that if we just took our hands off of markets, that they would sort of naturally reach some sort of equilibrium, and they would distribute and allocate economic goods most efficiently. But I think what I heard in your presentation, and what I also believe, is that doesn't happen. Markets are governed by rules, which can be set democratically, or they can be set by the most powerful actors within the economy. So I'm curious if you see an opening and a change in our orientation to economic policy, a willingness now to actually ask the questions that you're asking and say, no, we're going to use as much state capacity as we have to help influence the trajectory of the economy in a way that's going to benefit Canadians.
So you picked up on that subtlety, did you? Yeah, everything's the same except the context, right? And so, yeah, I think this is a good time to kind of step back a bit and say, what does this mean to us as a country? What do we want? And once bitten, twice shy, right? And so we're all building in risk factors that we never thought were, very high in our consideration. So now you have to cost in supply chain shocks. You have to cost in trade barriers. You have to cost in, and so I think we could either drift there and slowly get, or we can say, well, no, that's the reality now, and so let's rethink, our fiscal, monetary, regulatory. Let's rethink some of those things and say, okay, if we're going to have a country with certain values and the kind of standard of living that we want and the productivity that is essential to that, well, then what is the framework that's going to work for us? And so, yeah, I'm not advocating, intervening in all market factors. I think market forces should, as a default, do things. But it's been a long time since Adam Smith kind of, talked about some of these, and the world has changed a lot, and continues to change at a pace that's very different. So I think there are areas that, we need to stimulate certain things, that complexity, the diversity that we talked about, that geographic or industrial. So the government has to play a role in that. It's not just going to happen. Have a look at how it just happened, and it didn't really work out that well. So so where we've neglected or vacated, well, we have to look at what are the policies that are going to have to get us back in, and that means it's going to have to be some smart investment. And so, yeah, and when the market does, then I think we have to have the wisdom to step back and not intervene unnecessarily. But yeah, where there are, I think we need to be mindful of those, and I think we need to have a smarter policy that makes sense for Canada.
Well, and I think one of the mechanisms you talked about was the federal procurement and the ability for government to use its dollars to stimulate some of these industries. And you particularly mentioned defense as one form of reindustrializing in Canada. I was curious if you could, pick a couple of other potential manufacturing-based industries that you would like to see reindustrialize, if you had any thoughts.
Yeah, look at our pharmaceutical industry. I think, and have to look at it with maybe more of the data at the center of it as a very, very prized commodity now. I mean, we have a diverse population. The kind of information that we have at our disposal is hugely valuable. So how do we take some of those intangibles and start to build some of that base up from what are our strengths? And how do we build the kind of infrastructure that allows us to do that? How do we build the regulatory components around it that favor the responsible use of that pharmaceutical, aeronautical, even our, food, systems and so on. These are areas, and I know Superclusters kind of looked at some of these things, so we can build on some of that work. And so, yeah, I do see, in addition to the defense sector, a number of these sectors that actually, even their whole renewable space, right? We have a lot of strengths in this country. So I think they can have the kind of manufacturing components to each of those, so that we can actually, I'll just make a statement. Like we got to think beyond our resources. I mean, think about the fact that you can move a barrel of oil anywhere in the world for a couple of bucks, right? So is it necessarily the fact that we have the resource that's the only place that we have to build the manufacturing capability? No. In fact, moving, like so many economies in the world, chocolate, right? The beans aren't grown in Switzerland as far as I know, right? So moving things around can be done, in a very cost-effective way. It's about the knowledge, it's about the people, it's that is important, and how we allocate that in a way that gives us the productivity gains that we want. I think that is the secret going forward.
Well, I want to talk about oil because you grew up in Alberta.
I did.
And in my own family, I've got some connections to oil as well. I was interested, and we were talking about this before, that, what you made some pretty stark sort of comments or, it's some stark data looking at our reliance on oil and gas as one of our primary sectors in Canada. And I'm curious what those trends sort of portend about the future for Canada's reliance on that as such a big part of our economy. Particularly, you mentioned renewables, and we were also discussing earlier about how, one of the potentially benefits of this war in Iran is that it could be the biggest kickstarter to the green energy transition globally, because people are realizing how dangerous it is to be reliant on one single source of energy. So, curious if you could say, 20, 50 years from now, where do you think oil and gas will fit in Canada's economy and part of our mix, our product mix?
So first of all, full declaration, I worked in the oil and gas sector, I extracted, I explored, and benefited, come from Alberta. Whether it's forestry, mining, oil and gas, I worked in Natural Resources Canada, so I still believe these are Canada's, hidden treasures, they're assets for the country. And they've done very well, as a lot of the charts shown illustrate. The kind of gains that we've had for a long, long time is the reason why we are where we are. So we would not be even at the kind of prosperity we are without them. And so we are, I would argue, probably one of the only sources in the world that still it has, trades freely. We extract and use them responsibly, and we continue to year in, year out bring the harmful effects of those activities down. So as I said earlier, this isn't one good, one bad. It's about Canada. It's about productivity. It's about our standard of living. And I know there are many views around this in the future, but it is a limited commodity, and it is for the most part controlled by regimes that are, not open markets and maybe not responsibly done, and so and the world still needs, whether it's transition in the case of natural gas, or whether it's oil and gas or other commodities. So, I think critical minerals, and they're a critical part of the renewable economy. So it's not like we can, all these things are, shut off one day and turn on another day. We're a long ways from saying the world doesn't need these, and why would we not continue to use them and do them responsibly? So I think the future of Canada is still very much dependent upon the natural resource sectors and our ability to use them responsibly. And so the way to the future is through them, is in a way, if you know what I mean, in terms of the paybacks and the investments and the reinvestments. And I think Canada holds a huge advantage globally when it comes to, and I think it has some very, very positive and important spillover effects for us. What I'm saying is it cannot be cyclical, and it cannot be that, when, like now, we just take our eye off the ball of everything else, because as that curve, right, that I started with showed, every time we come out of it, we're worse off when it comes to productivity, our GDP per capita, whether it's comparing to the US. So it's an and proposition, not an or proposition. We need to manage our resource very, very carefully and responsibly, while taking advantage of all that other opportunity that just sits. We cannot do in the AI and the data space what we have done in many of the other areas. And we are not investing enough in those areas to see the kind of gains. We don't have the kind of IP protection mechanisms and the culture, as you talked about, where we actually create that knowledge and we commercialize that knowledge to our benefit. Those are the things that I think are almost kind of independent, as I mentioned earlier, of what we do. I think it's more creativity, it's the knowledge that we need to mobilize, and I think we have a lot of capacity in Canada, untapped potential in Canada.
You mentioned critical minerals, and I think, if I have this right, about 90% of all critical minerals are refined in China. So there's a big geographic concentration of refinement of these incredibly important minerals for our phones, our computers, our cars, every battery, et cetera. Is that something you would add to your reindustrialization mix if you could put your mood board up there and if you were sitting in charge of the Canada Strong Fund and making that decision as the CIO?
So let me come back to what I was saying earlier. Just because we have something, it doesn't necessarily mean that we need to now do the processing and the refining and in fact, when you look at productivity gains, extracting our resource and actually, exporting it gives us the biggest bang. And the returns diminish as we start to now, put more and more energy and effort into. So it's not just that. Okay, it's like, as I was saying, the Swiss chocolate example. You can bring the chocolate beans from anywhere. It's the ability to make something that everybody wants and wants to pay a premium for it, right? Now, as I said earlier too, there are going to be factors that we're going to have to now consider, like our sovereignty. And, could there be, as you said, right, in the critical mineral space, like now you got China controlling the world supply, and all of a sudden, everybody's kind of brought to their knees. And so, yeah, so those considerations come at a premium, right? And so there are going to, absolutely, we're going to have to think about some of those critical minerals and say, okay, from a defense, from a sovereignty, from a supply chain integrity perspective, what do we need? Okay, and there will be a premium that we play on it. That's that, don't just leave the market to do whatever it needs to, but you have to know what those are, and you have to know where you want to do those kinds of things. But it is not just a simple, because we have it, we should just go down the supply chain. I think we're going to have to kind of put more thought to where it is that it makes sense, and it's going to be more than just we can make money off of it. Some of those have to create that base capacity and that infrastructure that we need as a country, and so there are many. I think what I'm saying is that let's not be limited to what's in front of our face. There's so many other areas that I think afford us immense opportunity to complexify our economy, and especially in the intangible space.
Okay, we're down to our final minutes here, so I've got 2 last questions for you. And one is actually a bit of a question about the profession of data gathering and analysis and interpretation, because you're a data guy. And we now have an incredible set of new capacities to understand ourselves. We have this whole new set of planetary sapience apparatus, like geospatial data. We've got we've got ecosystem monitoring. I mean, we also have vast surveillance, networks, both digital and in person. And so we're creating huge reams of new data streams. Now we actually have foundation models with AI that can help us parse some of that, do pattern recognition and so on. So I'm curious from your perspective, I mean, you were Canada's chief statistician for a number of years. How do you see all of these new capabilities influencing our ability to understand the patterns in the economy and how we might respond? And do you see those new capabilities actually influencing economists or some of the older institutions that were using perhaps more crude tools in the past?
Mm-hmm. It's a big question, and so we can stay for another hour. Is that all right? I teach a whole course on this. Look, there's no question data, the volume of data just absolutely exploding. And in fact, AI is generating more data. You talked about some of the sources. And so we have to be mindful about volume versus quality and then usability. And it's not all clear. I think there's also, if I could, the old sort of thinking was we would have a theory, we would go out and try to disprove it by conducting experiments, collect data, and then we would, we would either refine the theory or say, no, didn't work. Well, nowadays, I think we're more into correlations, than any kind of theory that says, yeah, underneath this makes sense. We're just saying, okay, these two things in whatever data set kind of seem to be, moving in a particular direction. And so fair, if it's a pattern recognition of, a cancer cell or whatever, that's very helpful. But I think in the process, theoretical foundations can't be a casualty. Our whole knowledge base is on this theoretical base. All our economic theories, all our physics, chemistry, they're based on these theoretical foundations. And so I worry about just causalities and patterns and that atrophy in actually deeply understanding phenomena. So I would just say, just because it kind of correlates, dig a little deeper, look into the last point is, technologies become, like AI, et cetera, become, sexy, and everybody wants to just kind of throw their whole data set and, subject it to ChatGPT or Claude or whatever it is, and they have no idea about the underlying quality of their data. Pay attention to the data. Do you understand the metadata? Just because there are 2 data sets that say adult, what does that mean? What was the age group? Do they actually kind of, what was the time that it was collected,
Okay, I see Paul
is
there.
giving us
I want to ask one last rapid fire question.
20 seconds.
Okay,
Go for it.
We all know this is an important moment for Canada.
Yes.
If Canada gets this right, what does Canada look like in the decades to come?
The best country in the world.
Perfect. Thank you.
With 2 seconds to spare.
Yeah, that was great.
What a great way to end the session. And so thank you very much to you both. Thank you, Denise, for teasing out those additional layers of issues here, and Anil for a great lecture. You made me think earlier about the joke, which was, I'm from the government, I'm here to help. And I was thinking that that's a terrible opening line, right? But the equivalent here would be, I'm from a think tank and I want to talk to you about productivity as like a showstopper kind of thing. But what we really want the focus to be here is that this is about living standards and affordability and your children's future. And therefore, you need to be focused on these issues and take action, right? Whether it's at the firm level or pushing government for the right actions. And you touched on a number of them, Anil, at the end of the lecture there, which were to say this is a critical moment for industrial policy decisions, whether it's transforming the defense sector, which has often been the means to industrial transformation in countries. The spin-offs that relate to aerospace, obviously it will be important to quantum technologies. I think it will also be important to even natural resources, the way that those are kind of digitized in a world where people want transparency and they want to be able to track where things come from and that they're reliable and that the trust is there. Canada can lead. We need to get the Sovereign Wealth Fund right so that it actually points in the direction that Norway has done with its fund. So the last thing I wanted to do was a few thank yous. As you know, it takes a village to put these kind of things together, and when I asked for the list of who was involved, I actually got the list of a village. So I don't have quite the time to read out all the names, but I want to thank everyone that was involved and call out a few people: Grace Wright, Noel Gruber, Anne Blaney, Christy Clement, Tim Lewis, and Richa McCutcheon for making this possible. Thank you for being here, and again, thank you to our speakers for this evening.